Okay, welcome everyone. In today's session, week 11. Okay, one more class to go in the final class next week. So we'll be discussing about basically reviewing the class and the types of question, pattern of exam, and all we'll be discussing in details in next week. Today's class is in terms of course structure. We'll be studying accounting for partnership. Okay, that is chapter 13. So we are skipping chapter 12. That is non-current liability, but we are moving to partnership. Basically not that much difficult in terms of understanding. It's just a simple calculation and some journal entry that we have to understand from this chapter. Let's see, the objectives for today's class is basically characteristics and types of partnership. So for the accounting that we have studied, mainly it was around not the proprietorship business only, the single owner, not so much complication. But now we are trying to understand a bit about the partnership, and probably in the next class or next course that you will try to get more in-depth analysis on company share, company accounting, which is the foundation or which is the basic or the all accounting that you are studying. Okay, so you'll have a course, at least 2 courses, I think, financial accounting, 2 financial accounting, and then you will have a company accounting, or in other words corporate accounting. All will be discussing about the company's share issue, consolidation, and this kind of stuff. But this class, the basic class, introduction to accounting, we are not going in details of any of this. And then we try to understand from this today's lecture is commencement of partnership. When we start a business, what kind of journal entry that we give. Okay, allocate profits and losses to the partners, which is the most important in today's class. Account for the admission of a new partner. Sometimes you'll see the new partner is coming in the business and old partner is going out as well. So withdrawal, if someone is leaving from the business, how much money we should give to him, or does he really require any kind of compensation from us, something like this. And then if we dissolve the business, if we liquidate the whole partnership business, how much profit or loss we will be distributing among the partners. That's what we will try to understand from today's class. Okay. So the sum of the characteristics is not like sole business or the proprietary business. When you go to make a partnership, we need first of all a written agreement. Okay, sometimes it can be even without any written agreement or any contract. It can be between mutual understanding, but still the written agreement is a document that you can provide to the court or to any legal entity. Whenever you are going for a business or you are looking for an AVN number or anything, if you are doing a business with 2 persons, then it has to be divided by, it has to have a written agreement. Limited life, mutual agency, unlimited liability, co-ownership of property, no partnership income tax, partners capital accounts. No partnership income tax means basically you don't give like a company's tax, something like this. Again, it is going to be individuals earning, because we will be distributing profit between 2% or 3%, and they will have to pay their own tax based on that one. Okay, it's not like a company account. Company is making profit, you are giving 40% tax and then deduct the profit, but here the tax will be distributed individually. So your earning from this business is $60,000, you will be giving tax on $60,000. The other partner is earning probably $20,000 from this business, he will be giving tax on $20,000. So tax is going to be in individual basis. Some of the characteristics of the partnership business, not going in details. Partnership can raise more capital. That is understandably point that if 2 or 3 people come together, definitely they will have more capital than having a single business. Partnership brings together the abilities of more than one person. This is another good. Maybe your partner has a good skill in accounting, you are not, you have an engineering background, or maybe your friends have an engineering background, doesn't have a lot of accounting skill. You are good at accounting skill, but the products that you are developing probably requires an engineering background knowledge, something, so you can merge together. Okay. Partners working well together can add more value than by working alone. This is we call 1 + 1 more than 2, greater than 2. That is we call synergy. Okay. Versus companies, partnership is less expensive to organize than a company. which requires registration with a government authority. If you are looking for a company, when you see the company accounting, you will see there are lots of procedure to come in a company. Okay, to form a company, you have to go through lots of documentation, legal documents, registration, and everything. But in case of partnership or even its proprietorship business, you don't have to go for all these things. You just need a one ABN number that you call a single number from the tax office. You can find it easily. Partnership income is taxed only to the partners as individual. It's not like company that you are getting double taxation. Okay. The disadvantage is that we can record partnership agreement may be difficult to formulate. Each time a new partner is admitted, a partner withdraws, you will have a problems. Okay. Suddenly a partner is decided to go out from the business, okay, and he wants to withdraw his capital. You will be in trouble because you can't, either you have to find someone to replace the withdrawing partners, or maybe you have to buy the whole business, or maybe you have to dissolve the business. Okay, so that becomes a trouble when you are in the partnership business. Relationship between partners may be fragile, sometimes not trustworthy, and mutual agency and unlimited liability create personal obligation for each partner. Okay, one is called general partnership that we normally form, that the business will go, each partner is co-owner of the business with privilege and risk of ownership. The other one is limited partnership can be formed, the liability of some of the partners is limited to their investment in the business. So in case of general partnership, whenever we say, okay, you go, you put $10,000, I put $10,000, and we will all work for the company, or I mean for our business, we divide all the liabilities, responsibilities equally. But it can be limited partnership. For example, one of the partner is not actually contributing financially anything. You are the one who is contributing financially, at the same time probably working for the company. So if the business is getting dissolved, zero, made a loss, the one who did not contribute financially probably is not losing anything, is losing only his time, right? So that, or maybe we can limit whenever a new partner is coming, if the business is dissolving, if the business has a loss, we will give only 5% of the loss, 10% of the loss, not 50%. Okay, so that can be formed as well. Probably the partner that I'm looking, he's very capable. Okay, he's very skilled. I really need him. So that's why I need to offer him that the loss, you will not have to carry the loss. Okay, you just spend time with us and you will get the bonus, or you will get the profit sharing. So this can be done as well in the partnership business. The partners may invest both assets and liabilities. So you have a business, I have a business, we can come together. I bring all my asset and liability, you bring all your asset and liability, and we can merge together and we can form new business as well. This is one way. These contributions are journalized by debiting the asset and crediting the liabilities. The excess measures each partner's contribution. The partnership records the partner's investment as a current market value. We'll see some of the example. So you are bringing an asset from your business, okay, and that, for example, a vehicle, Toyota vehicle, maybe the market value is $10,000 and the cost price is $5,000. Whenever we are forming a new business, basically I will be recording this as a $10,000. Is that okay? We will always be recording as a market value, because I'm bringing my vehicles as a market value that will be used. So whoever the partners is contributing by assets, the asset will always be recorded as a what? As a market value. Let's do some of the simple example from here. Okay. Sheena Bright's investment. So she has a cash of $10,000 and inventory of $40,000, and she also have a liability of $80,000. The current market values for these items equal Sheena Bright's values. So whatever the contribution that she is bringing is 10,000 plus 40,000, 50,000, and he has the accounts payable of $80,000, so a liability there. And he's also bringing a computer that costs $80,000, accumulated depreciation $20,000, but the current market value is $55,000. So our concern is which one? We'll be taking the market value. Now, Franco is also bringing cash in the business and also bringing a computer software cost that has a market value of $18,000. Even though the cost value is $20,000, we will be ignoring this $20,000. Now whenever we are contributing to a business, right, what is the norm? For example, don't think about this part. You are just starting a new business, and that is the things that you are giving to the business. What is the journal entry? It's going to be cash debit, because that is your asset, inventory debit, and then computer equipment that you are bringing for the business that has a market value of 55,000 is also going to be debit, and you also bringing a liability that cost $8,000, so that is your liability. So the difference between these two is $25,000 is your capital. Is that okay? Now similarly, he is also giving cash to the business $5,000, computer software he is giving $18,000, and his capital is going to be $23,000. So now the business has capital of 25,000 plus 23,000. Total capital for this business is going to be $48,000. Is that okay? Allocating profits. So now you form a business, and the second important part is, of course, when it comes to the allocation of profit and loss. The partners can agree to any profit and loss sharing method they want. And second, typical arrangement include the following. For example, sharing of profit and loss based on a stated fraction. Okay, even though your capital is there already, someone contributed 25, another contributed 23, it may be 50-50. We decided early in the business, okay, my capital is even less, but still when it comes to the profit and share or loss sharing, it might be 50-50. Then sharing based on each partner's investment. Okay, you contributed $10,000, I contributed $20,000, so the allocation of profit is based on our capital. Whatever is your profit, my profit has to be double of this. Is that okay? Simple. If you have a $15,000 income or profit from here, he will get 5,000 and he will get $10,000, because his capital contribution is just double of the other one. Sharing based on each partner's service, it can be that well, or sharing based on a combination of the above. So mainly we will be focusing this part. It can be actually a combination of the all of this. Allocation. If the partnership profit for the year is $60,000, the income summary account has a credit balance of $60,000 prior to the final closing entry. So Bright and Giacobetti allocate 4/5 of the profit and losses to Bright and 1/5 to Giacobetti. So what will be the journal entry? If we transfer the amount, right, when we give the closing entry, income summary is always what? Why income summary is debit? Do you remember anything from closing entry? What we are doing actually, we are transferring the profit to their capital account. Is that okay? That's why the capital is getting credit, because, and the capital is what? Increasing or decreasing? Capital is increasing. So that's why capital is going to be credit, and that is the income. So we are actually dividing 4/5 and 1/5. So it's given 48,000, 12,000 profit, and is going to their account. Capital is going to be increased because net income is distributed between these two people. If it is a fraction given, for example 2:1 or 4:1, then this one is probably 2:1. Okay, right? It's going to be 2:1. Sheena Bright, then how do you calculate? 2 plus 1 is going to be 3, so it's going to be divided by 2/3 and 1/3. Is that okay? Should be easy when they give a ratio. Just first we add these two. If it is 3:5, then how do you do it? 3 plus 5, 8. So the first one will get 3/8, the other one will get 5/8. So this is how we will be distributing if the ratio is given. Okay. So again, it's going to be income summary debit and capital is going to be credit. Allocation based on a stated fraction of a loss close to either the partner's capital account or current account. If instead the partnership has a loss of 15,000, the income summary account would have been, what will happen? If we make a loss, whenever we are making a profit, the capital is what? Increasing or decreasing? Capital increasing. But when we make a loss in the business, then capital will be Decreasing. So when the capital is decreasing, capital has to be debit. Very good. So capital is debit for both of them, and we are using the same fraction, 2 by 3, 1 by 3. Income summary is going to be what? Credit. Income summary, usually when it is loss, it has a debit balance. So you are making him credit, means he is going out from our account. Okay, let's try and see. Can you try? Give a try this one. Let's reconsider Bright and Giacobetti's original agreement. Sheena Bright invested 25,000, whereas Franco invested 23,000. But Giacobetti devotes more time to the business. Accordingly, the two partners might agree to share profit as follows. The first allocation are based on 10% of the partner's capital balance. The next 40,000 is allocated based on service, with Sheena Bright will get 16,000 and Giacobetti will get 24,000. Any remaining profit is allocated equally. Can you try that how much each of them will get the profit? The profit is $60,000. That's the missing information here. The total profit is $60,000. 2 minutes time. $60,000. So I want to distribute $60,000. These two people, Bright and Sheena Bright and who is the next? Giacobetti, right? Sheena Bright and Franco. This is easy. So can you distribute this $60,000 to these two partners based on this condition? The first allocation is coming based on the partner's capital balance, and second $40,000 is coming. 16,000 is given to Bright and Franco is getting 24,000. If there is any money remaining, that should be allocated equally. Can you try how much each of them will get in 1 minute? Just do the calculation. I just need the calculation. Should be simple. Just want a quick calculation from everyone to see whether you have got the understanding or not. $7,600 for Sheena.
Yeah, each person finally.
Finally is 7,000 for each of these. Okay. Total, we need the total as well, right?
Into 2 minus 15,200.
So we need one balance for Sheena. Okay. Sheena. No, actually, right. Sheena and Franco. So the total amount is 60. It will be divided, will be distributed, right? How much Sheena will get finally and how much Franco will get finally? This one? So 7,000. But before this, they have some other balance, right? She'll get 2,500, right? 10% of this. Yeah, 2,500, 2,300. Very good. And then, very good, 16,000 and 24,000. So that is it. Then how much is remaining? Now all together 60. Have you got the guys?
Yeah.
How much? 31,900 and this 20,100. 28,100. Okay. Is this the correct answer that everyone else got? No one? I'm not sure is that correct or not, but let's move. Just give another 10 seconds just to get any other answer that you have. Should be very easy, right? 2,500, 2,300, 16, 16. after calculating this, whatever money is remaining, we are just distributing it equally.
It's 33,900 of Franco.
33,900.
No, of Franco.
Franco is
33,900.
So any remaining profit is allocated equally, means the total profit is 60,000, right?
yes.
They have already allocated 40,000.
No. First they allocated 2,500 and 2,300, and then they allocated 1624. Whatever is remaining should be distributed equally. We see here it is 33,900 with Franco, and Shina is getting 26,100. How? So first of all, she's getting, of course, 2,500, 2,300. That's simple. 1624, and then remaining money is 7,600. How much we told? 7,500 something. 7,600. Very good. So it's all together is going to be 26,133,900 dollars. So the total is going to be $60,000. Any question with this? So if the partners is drawing from the business, let's go quickly with this. Any problem with the previous calculation? No? Okay. If the partners are drawing from the business, of course the drawing is going to be, right, debit, drawing is debit, and cash is going to be credit. And finally that drawing, of course, we have to adjust with what? Capital. So because of drawings, capital increase or decrease? Capital decrease. Capital decrease means capital will have to be debit or credit? Debit. If the capital is decreasing, capital will be debit. So capital debit, and their drawings are going to be credit. We are just closing the partners' drawing accounts. I think you did it when we are doing the closing entry, right? How many types of closing entry that we studied? 4. One is to close the revenue, another one is close to the expense, and another one is close to the drawings, and another one is to close the profit to the capital, right? Did you write all in the assignment? 4 journal entry? No? Okay. Okay, let's talk about the admission of a partner. So for some reason, okay, there could be the new partners is coming and the other partners can go. Anytime the partner mix changes, the old partnership ceases to exist, that means it doesn't work anymore and new partnership begins. Okay, let's see some of the examples from here. The partners can actually come by investing in the partnership at carrying amount, and bonus to the existing partners and bonus to the new partners as well. So we'll see each of these case. Okay, sometimes a partner is coming and he's contributing very less, but we are still giving him 1/3. In other words, it could be the opposite as well. The partner is coming and bringing a lot of money, but we are giving him 1/3. For example, he is giving more than what is 1/3. There could be different reason. One is our business is in trouble, okay, and we desperately need someone who is very skilled. So we are asking a partner, you come, just contribute 10,000, but your profit and loss and capital will be, let's say, 1/3. Okay. It could be the opposite. Our business is doing very well, so when a partner wants to come, we demand him to give more than what he will be receiving from the business. Is that okay? So it can be either of these cases. We'll see each of these separately. So look at this. Laura Cable wants to join the Bright and Sheena Bright and Giucovetti's partnership on January 1st, 2017. Cable can invest land with a market value of $51,000. Bright and Giucovetti agree to dissolve their partnership and start up a new one, giving Laura Cable 1/3 of the interest in new partnership for her $51,000 investment as follows. Okay, so partnership before that was $48,000 and $53,900. That is $102,000. Is that okay? If you divide it by 2, actually is getting $51,000 each. Now the new partner is coming and he is contributing 51,000. So basically whatever he is contributing in the business, he is just getting exactly same. Is that okay?
From where we got that 48,153?
This one,
Yes.
okay, initially they started a business. This one we get usually supposed to be from the previous slide. Let's see, whenever we calculated this. So if we allocate this profit, okay, and add, and then if we deduct these drawings, probably it will come around this amount, okay, assuming that this is going to be their capital, partnership of Bright, and this is the partnership capital of Gecobity. Before the business starts, or there are already only two business people. Is that okay? And now the third partner is coming and he's contributing $51,000. So the business value for 2% is 102. The third partner is coming, contributing equally. Total partner is going to be, value of the business is going to be 153. If you divide it by 3, each of them will get, for example, 51, 51 and 51. So the new partner, the point that we want to make, the new partner, whatever he is giving to the business, he is not getting more, he is not getting anything less as well. So his contribution is exactly same like other people, $51,000. Is that okay? So a partner just come, business is probably going normal, they don't need anyone, or if somebody comes, they don't mind as well. There is no surplus or shortcomings here. Only the partner is coming, whatever he is contributing, he will get the same amount of money. So his capital is going to be, land is going to be debit, the business is getting now a new land, and with his name we open an account, that is a capital is going to be $51,000. Is that okay? Admission by investing the partnership, bonus to the existing partners. Now assume that the business is going very well, okay? We don't want many people, but there are many interested people who wants to join in our business. So what they are doing? Sheena Bright and Franco, they have a 1/4 interest to the new partnership for Nancy's cash investment of $98,000. Nancy Fry's capital balance on the new partnership books would be $50,000. Here is the problem. This, she is coming to the business and she is willing to pay $98,000, but she is happy to take a capital of $50,000. You got the point? No, right? So 98,000, I will give $98,000 to the new business because I see this business has a potential a lot in the future. So 98,000. What about the capital? Let's see, then we will be able to understand. Partnership before Nancy is $102,000. If we divide it by 2, how much? It's going to be $51,000. So what in the last example that we saw, if a partner is coming with $51,000, that means he is giving exactly the same amount that other two partners have. But the new partner is coming with $98,000. So the total capital is of the business is $200,000. Okay. Now Nancy Fry's capital in the partnership is basically going to be 200 by 1/4. So he is giving $50,000. Even though he is giving $98,000, officially we will be recording him as a $50,000. The question is then, how about that additional $48,000? Where it is going? Where it is going? $48,000. The bonus to existing partners, the other two partners who are already in the business, who established this business, they will say, look, we divide this 48,000. So 24 will go to the Sheena, another 24 will go to the Franco. Have you got the point now?
Does that 48,000 go to other partners' capital?
Other partnerships capital, yes. So their capital now will be increased by, let's say, 24 and 24. So here is the, why he is coming in this business by giving 98,000, he is taking a 50,000. Probably the business is very, very good. In future, they will make lots of profit and the business looks very potential. That's why he is doing this sacrifice. Have you got the point? Any problem with this, understanding this? One new partner is coming, he is contributing $98,000, but he is getting a capital of $50,000. The question is, how is this additional 48,000 is going? The 48,000 is going to the existing partners who established this business. Is their hard work's reward. Okay. So if we do this, cash debit, okay, and Nancy Fry's capital is 50,000, what is going to be? Of course, his capital is going to be $50,000, but he is contributing how much? $98,000. Additional $48,000 we are distributing to Sheena and Franco. So Sheena and Franco's capital is going to be increased by additional $24,000 and $24,000. Let's go by bonus to the new partner. Okay, this is now exactly opposite. Now business probably not doing anything. It's rubbish. I mean, we're making lots of loss. Now we desperately need a partner who can help us. So one partner is coming. Let's go back with this example again. So they had already a capital of 98,000 as before, but gets instead 60% of interest in the new partnership. The calculation of fresh 60% equity partnership is as follows. For example, this guy is coming 48,000. We already had a capital, right? And she is contributing $98,000. So capital after is going to be $200,000 is total capital, right? But he is getting 60%. Nancy, the one who is coming new to the business, is getting 60% of the capital. Now her capital becomes how much? 120,000. Have you got this? Capital. So he's already gave $98,000, but in the business I am going to record her capital assuming that she provided $120,000. Is that clear? But the question is, she provided $98,000, then how can she get $120,000? So that is our sacrifice. The existing partners who are there, they are giving $22,000 bonus to her capital. So what will happen this $22,000? Who will provide this? Sheena and Franco, right? What will happen to their capital? Will increase or decrease? Will decrease. So simple, we will be recording their capital is going to be, cash is going to be debit, their capital is also going to be debit. The new people, the guy who is coming, Nancy, her capital is going to be $120,000. Is that okay? So if you do some more exercise, might be good. If a partner is withdrawing from the business, and if we liquidate the business, if a partner is withdrawing from the business, it could happen either way. One, the partner is going from the business, maybe you can give him his amount of capital, and the business overall capital will be reduced. In case of liquidation, what will happen? Liquidation shuts down the firm by selling its asset and paying its liabilities. So the final step is liquidation is to distribute any remaining cash to the partners based on their capital, current account balance. Okay, liquidation includes 3 steps. First of all, sell the asset, all asset, allocate the gain or loss to the partner's capital account based on the profit and loss sharing ratio. Okay. Second, pay all partnership liabilities, and then third, pay the remaining cash to the partners based on the capital balance. Based on the capital balance, the important thing is not their profit and loss sharing agreement. Profit and loss can have different agreement, but when finally we are distributing our capital, then the capital should be redistributed according to the amount of capital that we contributed in the business, right? For example, the profit and loss sharing ratio is 50-50. For some reason we decided we will be taking this 50-50, but in the business I contributed $100,000 and my partner contributed $200,000. Is that okay? And now we have exactly, for example, after selling all of this, we have $300,000 in the business. Now if we divide on 50-50, he will get 150, I will get 150. Is this a correct entry? Correct adjustment? No. I contributed in the business $100,000, so when the business is dissolved, I will get only $100,000. My partner contributed $200,000. When the business is dissolved, he will be getting $200,000. If we use the profit and loss sharing ratio, we will get actually 150, which is unfair. Because I provided 100, I can't get 150 when dissolving the business. Is that okay? From the capital. So that's why it has to be based on the capital balance that they contributed, not based on profit and loss sharing ratio. Okay, assume that Abram, Black and Krantz sell their non-cash asset for $150,000. Carrying amount is $90,000. The partnership realized a gain of $60,000 allocated to the partner based on their profit and loss sharing ratio. So we have a cash $150,000, we are selling $90,000. So the whatever $60,000 is gain, right? And that is going to be distributed to Abram, Black and Crane. Okay, 60, 20, 20. So their capital is increasing now. Accounts payable debit. So the partnership then pays its liabilities. If we have any liabilities, we are paying liabilities debit, cash, credit. Why everyone is leaving from the class today? Okay, now the partners divide the remaining cash according to their capital balance. So whatever the cash balance now we have in the business, we are just distributing to our partners based on their capital balances, 66, 32, 22, and cash is going to be credited by $130,000 that dissolve our business. Now business has basically zero asset. If you do a summary of this, it comes like this. If you can prepare a simple financial statement here, the exam might be very important. So we start with the revenue and expense, and then allocation of profit we distribute in the income statement based on their whatever capital ratio is given, or any capital balance, or any profit and loss sharing ratio is given, we distribute among this. What happened? We haven't finished the class. Very soon. Okay, so this chapter mainly will be focusing on recording the entry for commencing a new business, and then second, distributing the profit and losses among the partners. This is the most important. And the third is when a partner is coming with a bonus, or maybe if you are giving any deficiency, if you have to give bonus to the partners. So these three types of calculation that we'll be focusing in the tutorial in the next class. And if you have no question, then we'll finish it here for today. Any question before we finish? No? Thank you.